In this video, what I'm going to do is I'm going to lay out my hypothesis and my reasoning. We're going to go over some facts and assumptions that I have, and we'll jump into a lot of different details. There's a lot to get into when it comes to Zephyr. It's somewhat complicated. If you have any questions or comments, please leave those below. I'll do my best to answer them. And this is zephyrprotocol.com. You can go on their website, take a look. There's a lot of blogs and information about it if you want to get more details. Let's just jump right into my hypothesis, which is that wrapped ZYS is going to disrupt the entire stablecoin industry in a way that I honestly think nobody's really prepared for. And it's going to have a result or consequence of pushing the market cap of ZEPH to over $1 billion by late 2026, which is 200x from current prices. And my reasoning is that the fees, slippage, and arbitrage from swaps will force the price of ZEPH higher, and when ZEPH goes higher, that means that the variable APY of ZYS is going higher. And really that's the same thing as saying ZYS price is going higher, which places more buy pressure on ZEPH, and then this feedback loop continues. So just to be clear, when ZYS is going higher, it's my opinion that because the price of wrapped ZYS is going higher, because it's tracking it, people will be interested in buying more of it simply because the price is going up, and they'll swap ZSD into wrapped ZYS, and that price will go higher and higher. And the reason that that would force ZEPH price higher is because of fees, slippage, and arbitrage. And so really specifically the hypothesis is that swapping itself through these Ethereum pools, and there's a very specific mechanism by which swap pools work, and the liquidity providers and the amount of liquidity kind of plays a role in the amount of arbitrage and slippage and fees that takes place. Those specifics will actually end up driving ZEPH higher, and I'm going to lay out the reasoning and the facts that I have about that in just a moment. But when ZEPH then goes higher, it will increase the ZYS price, and that's just how the mechanism works. The problem with this hypothesis normally is that these feedback loop mechanisms work in both directions, where if people want to sell wrapped ZYS, then suddenly you get slippage to the sell side and arbitrage, and then you get the flywheel in the opposite direction, and then obviously it can crush the price. However, with Zephyr Protocol, they've actually designed something that's new, that nobody has developed, that really is the linchpin to my argument. And the real reason this whole hypothesis works, in my opinion, is because wrapped ZYS has a capped downside. And it has a capped downside because ZYS only goes up. So the native coin that wrapped ZYS is based on is designed as a liquidity pool of ZSD, and that pool only increases in value. It can never decrease in value, and we'll try to get into that in a little bit, but I just want to point out a few things here. ZYS was launched on October 14th, 2024, and since that time it's only gone up in value. It's never gone down in value. And if we look closely, we can see that right before it launched, there was a huge price increase from $1 to $4 or so for ZEPH, and that's kind of like a buy the rumor. And then there was a sell the news event, and we can see that even though the price of ZEPH went down over that small period of time, ZYS price kept going higher. And then there was a lot of buy pressure that took place again, and the protocol was working fine. Maybe people had more confidence, and that drove the price of ZYS higher faster, and we'll talk about why that is in a moment. But then since December, when an exploit was discovered, and there was a lot of fear that somebody exploited the chain for 50 million ZEPH, which is like 3 times the max supply. So really there's a lot of fear at this point, tons of selling that took place. It was discovered that this exploit potentially happened back in July of 2024, I believe. And since that time it was discovered that no, 50 million was not suddenly minted out of thin air, but there was an exploit, and it was actually 2 million, which was 20% of the circulating supply, and that's a lot. So there's been a lot of lack of kind of faith or trust in this protocol, and that also does explain why the prices crash so much over this period of time. But mainly a lot of this price crash, I'll say, is is related to the fact that there was fear that 50 million ZEPH was actually minted. And although the price did go down from $4 to below $1, the price of ZYS actually never went down. It just went up slower. And that's because the way that ZYS works is that it essentially is just getting block emissions from the proof of work chain that ZEPH is. And we'll explain that in just a minute. But you can see also, I just want to point out that there's kind of this moment where it goes sideways. It doesn't go down here. You can check for yourself. It just goes sideways. And that's because this is when the audit took place to check if that exploit actually was 50 million ZEPH. And they discovered it was really only 2 million, which obviously is a lot. They've since fixed that exploit and they've recoded through a hard fork. That cannot happen again. But there's really a phantom line here to here, and the price just went higher and higher. So this protocol is working perfectly fine. It went up over that period of time. It's always gone up. It's never gone down. And if you understand that, then you're really going to understand that this hypothesis actually makes a lot of sense. And we're going to get into a ton of details here, so just kind of bear with me. The first thing I just want to kind of explain is, well, how does it only go up? This isn't a typical coin. This is a very specific type of protocol that is like a pool with actual water, right? Just imagine. And then every 2 minutes you add more water to that pool. And you can have a stake or a stock, a certain number of shares of that pool. So let's say I have 11% of the pool. Then I'm getting 11% of the water that's added to that pool every 2 minutes. And the reason it's added every 2 minutes is because ZEPH is a proof of work blockchain. Every 2 minutes, a new block is mined, and there's about 8 ZEPH per block today, and that goes down over time. So that's obviously something to keep in mind. There's a lot of different dynamic variables you always have to keep in mind with this, and I'll try to lay out all of that information the best I can. But really what you want to know for now is that the block itself has a value. So if the price of ZEPH is at a certain point, when that block is mined, what happens is every time a block is mined, 5% of that block, that ZEPH from the block, is auto-converted into ZSD and then automatically added into the Zephyr yield reserve. And then the people who own a share of that reserve, they split that amount of value. And so over time it kind of trickles in, more and more water is added to this pool, and you can enter and exit this pool whenever you want. And in order to enter the pool, you need to add ZSD to the pool. So let's say I had 10,000 ZSD and I wanted to add that to the pool, and the pool price, let's say, was $2. Then I would get 5,000 ZYS and I would have 5,000 shares. And then over time, as more water is added to the pool, then that ratio or the price of ZYS would go up because more water is being added, and I'm essentially going to be able to exit with more water than when I return. So in the future, let's say that the price of ZYS is $3, then I will exit with my 5,000 shares, and that will be worth 15,000 ZSD, and I will have made 50% return, which is $10,000 to $15,000 as a result of that. And it's a stable coin. So stable coins, they don't go down in value, they are stable, and you're just adding more ZSD. It's similar to USDT, but it's private, and you're just adding more of this stable coin to this pool. And then, if it's water, the water is just growing and growing and growing. So I don't want to go into too much detail. This is actually kind of complicated, and I think I'll probably make a whole video about how this works, because this is really the linchpin of my argument, which is that ZYS only goes up. A lot of people, I think, just have a hard time wrapping their head around this, but this is in fact how it works. You can look at it. It only goes up. When I exit with my original amount of ZSD, and I get whatever's left over, or the extra ZSD that has been added. And then the way that math and ratio works is that everybody else who's left with their shares gets still the proportionate amount of shares, their original amount of ZSD that they entered, and then their proportionate amount of ZSD that they got from the block emissions that took place every 2 minutes. And so the price just grows and grows and grows. That's really just how it works. I probably will make another video on this. I'm sure a lot of people have questions, but just for now, take my word that this cannot go down in value. It can only go up because it's just the way it was designed. The other thing I'll point out right before I kind of move on is that this isn't your typical pool where there's slippage and arbitrage. So if I want to enter this pool, there's absolutely no slippage. I'll get exactly the ratio that it's at. So if it's 2 and I have $10,000, I'll get exactly 5,000 minus some fees. So there will be a little bit of fees, and those fees will actually go back into the pool and then be split amongst all the shareholders. Just like a company that has stock, right? Everybody gets a little bit of the value. And so when I leave the pool, same thing. There's absolutely no slippage whatsoever. There's just a little bit of fees, which then go back to the pool. And that's just how it was designed. You can look at the white paper, you can look at the blogs and all the details. You should really just test out the wallet and the native protocol and how it works, because this is a revolution that nobody's ready for. The thing is that nobody has seen this, or like big whales haven't understood it, or there's been barriers to entry. But my whole hypothesis is that everything is about to change because of swapping. And swapping is different because we're actually going to get into this in detail, so I don't want to jump in too soon, but swapping is the whole kind of idea. It's going to create fee slippage and arbitrage that is coming from the wrapped version that will then kind of work against the native coin, and then you'll see a huge kind of inflow, and this whole flywheel is going to take effect. But the main thing I kind of want to end on in this portion of the video is that it has a cap downside. So really, as it goes lower, there's going to be money to be made by arbitraging, and you will be able to do it. Anybody can do it. They're going to have bots be doing it eventually. So some people will just, who are smart enough, develop these automated systems that will arbitrage for them, and it will force the price back up so that wrap ZYS can never drop below ZYS that much. It will actually end up going below ZYS sometimes because it's a swap pool. That's how Ethereum and Uniswap and all that works. If you don't understand that, you should probably watch some videos on it. We'll actually talk about it a little bit later in this video. But the main hypothesis here is that as it drops below the native ZYS, arbitrage will kick in and it will pull it back up. And because ZYS cannot go down and it can only go up, then it will in fact drive the price of ZYS higher and higher over time. We're going to get into all these details in just a moment. Okay, so if you're not familiar with Zephyr Protocol, let's just kind of back up a little bit and let's talk about what it is and why it's so undervalued. So Zephyr Protocol is a private, over-collateralized, untraceable stablecoin, and it's decentralized. So that's a lot of catchy words. What does that even mean? So essentially, it's less stablecoin like USDT, but instead of being backed one-to-one by like US treasuries or US dollars in their bank account, or other backing one-to-one assets, this stablecoin is backed by a cryptocurrency called ZEPH. Just like you could back anything by a cryptocurrency. And really quickly, I'm just going to point out MicroStrategy, which is a stock company in the US stock market. It has these preferred stocks, and the preferred stocks, they're just like they're a special type of stock that has certain attributes. They have like a percentage of value that you'll get for holding them, and their actual price will kind of stay in a specific range. And the way that they work is they're backed by a collateral, and in this case that collateral is Bitcoin. And so these preferred stocks are actually backed by 6x or so, and that's over collateralized. So they have more Bitcoin per every stock that's sold. So if you sell $250 million worth of this stock, then you have to have 6 times more value of Bitcoin to back it up. And so this is a institutional grade, like very highly trusted technique that these companies use, and they're backing it by about 6x, and which is better than most preferred stocks in the industry, which are usually less than 3. But of course, these other preferred stocks are not usually backing with crypto, so you do back a bit more because crypto is volatile. So I just want to point this out because this industry leading instrument is using Bitcoin to back a stock. And it's really the same concept of what Zephyr Protocol is. You've got ZEPH. ZEPH has a price and a value. It's around 50 cents right now. And then you have a stablecoin, and that stablecoin is backed by, right now, around 500% or 5x the actual stablecoin. So every $1 of stablecoin, you have $5 worth of ZEPH. And so that's what over-collateralized means. Untraceable, that just means it's private. It's backed by the Monero XMR code base, so that it's got the kind of ring signature, and it's very, very private. You can't know who sent what amount or where they sent it. All of that's very, very private. Whereas with USDT or USDC or any other type of stablecoin, you can look and see everybody's transactions and see whether they bought that subscription or whatever they've ever bought. If you dox somebody's wallet, then you'll know everything they've ever bought. And so it's not very private. And then the other word here is decentralized. And that's because the stablecoin is not created by a centralized authority like USDT or USDC, which are centralized companies that can issue these coins. These are decentralized, which mean that they're just minted on a system that nobody owns and are decentralized across computers and is basically shared in terms of how they're minted and created. And there's a specific protocol that backs all of this. There's a code base. It's called the DJED protocol, DJED. And this protocol was actually invented by Cardano, Emergo, and Ergo Platform. And it was invented in 2020. And then Zephyr Protocol, what they did is they invented wZYS and they added it to the protocol. And wZYS has a dynamic yield bonding curve, which is just really a fancy way of saying that it has a variable APY and it goes up when ZEPH price increases. And of course, you need to buy ZEPH to swap wZYS. So it's pretty ingenious. So why is it so undervalued? Of course, the reason it's undervalued is because the blockchain was exploited and the crypto community lost, I think, a lot of faith. And so the price went from $50 to 50 cents, and it's down 98% from all-time highs or whatever. And so the reason that the price went down, in my opinion, is because of just normal sell pressure that happens when something goes up a lot. But also, it was discovered that there was an exploit. The exploit was confirmed, and those exploits were, there were two of them. They were discovered and remediated, and there was a hard fork, and they're fixed. And both of those exploits came from code that was either from Monero or from Hedina, and none of the code came from the devs themselves. Both of the codes had an audit from a third party, so it was believed that the code was secure. However, obviously it was not, and since then the exploit has been fixed, and the devs themselves who have developed Zephyr, none of their code actually was exploited. So I just kind of want to point out that nuance there and kind of also just point to why the price has decreased so much. I do want to point out that even though the price of Zephyr has gone down so much, the variable APY for wZYS has still stayed above 20%. And it's currently around 24%. So the price of Zephyr being at 50 cents and the APY being 24% is a really good sign that this protocol works the way that it was intended to, even under critical circumstances where the price drops so much. The value of wZYS still is maintained, and that's the whole point. The whole crux of my hypothesis is that as soon as the devs wrap wZYS and put it into your favorite DeFi wallet, this is going to be a game changer, because if you're getting access to 24% APY on a stablecoin, then you are definitely going to be interested in buying more of that, which will force the price higher, forcing ZEPH higher, which forces the APY higher, and then you really get this feedback loop. And because wZYS can't go down, you really won't have this death spiral that you see with things like Luna and other projects. If you want to learn more about Zephyr Protocol, you should definitely go to their website, check out their white paper. This is the most sophisticated protocol, and it's extremely undervalued right now because there's a lot of fear and a lot of worry and mistrust around exploits that took place. In my opinion, the devs did a great job of auditing the chain, checking what the exploit damage was, remediating the problem, removing the potential for future exploits. Remember, none of the code was the devs code. And since the launch of wZYS, the value has gone up 64%. 160,000 ZSD has trickled into this pool. So remember, imagine all of that water just adding up into the pool. The shareholders are getting that value, they're splitting it, and it equates to exactly 64%. It hasn't even been a year, though we're about a month away. So approximately, let's say 65% APY is what it was the first year. It's probably going to go down a little bit, but it really won't go down that much because ZEPH price is really one of the driving factors of what the APY will be. So as ZEPH goes higher, that will really support the number of people who could be added to the pool, and so it will really support the APY. And if you understand that, you're really going to be interested in this project because this is not something that was just developed overnight. Remember, these very big brain people developed this DEXs protocol, and then Zephyr created this yield-bearing proof-of-work stablecoin, and it was 64% so far. This is going to continue to be very impressive. It's a stablecoin that has 64% APY. You can't miss this. This is going to cause ZEPH to go higher. It's going to be adopted as soon as DeFi has access to this. This is going to go way higher. Okay, so what I want to do with the rest of this video is just go over the facts and assumptions that I have with regards to my hypothesis. So we know fact number one, that swapping is inevitable. The dev team have been posting multiple times on X. We can see this was September 21st. This was today, the 22nd. A new yield standard for DeFi, sustainable over collateralized, coming soon to EVM. And so, we're going to see all that potential liquidity from Ethereum move into wZYS. And that's really going to start this whole flywheel effect. And fact number two, it's going to be really easy to purchase. And the purchasing is going to happen via swaps, meaning that it's a pool. And that will cause price discovery because the liquidity is limited. And we'll talk about that in just a little bit. But basically, it'll be super easy. Today, it's actually quite difficult. You have to go to a centralized exchange, then you have to buy ZEPH, then you have to swap it in the wallet natively to ZSD, then you have to swap it to wZYS. But in the future, soon, you'll be able to get wZYS with basically one push of a button on your wallet, and probably it'll be paired with a variety of coins, like probably Ethereum and USDT. I would imagine that would be where it would start. Fact number three, the Zephyr dev team is considering Uniswap v4 hooks. So you can see here, this is dated September 18th, responding to somebody asking about swapping. And he says here that Uniswap v4 has hooks, which can help us a lot here, which I'm looking more into. So in this case, he's referring to, I think, the hooks that provide a dynamic fee, where as certain parameters are met, the fee actually will go up. And in this case, I think the dev is referring to the reserve ratio, which is the percentage of reserve that backs the stable dollar. As that reserve ratio drops close to maybe 200%, the fees will go up, which will de-incentivize people. And I think that's actually a really good idea. We'll talk about that in just a little bit. Just a little clarity on what the hooks are. Hooks are smart contract plugins that can customize how pools, swaps, fees, and liquidity positions operate. Like extensions can add tools to your web browser, hooks can add more functionality to liquidity pools and positions on the Uniswap v4 protocol. Hooks enable developers and liquidity providers to execute actions at specific stages of a pool's lifecycle, such as before or after a swap, or when liquidity is added or removed. This allows for greater customization of liquidity pools and positions. And so then they give you some examples. Of course, in my opinion, what ZEPH devs are going to end up doing is they're going to use these hooks to code certain smart contract parameters that will be like nothing you've ever seen. Nobody will have done this. And so I really think that, once they come out with some news about what this is going to be, it's going to be quite exciting. When it goes live, obviously, it's going to be quite impactful on the price of ZEPH. Okay, assumption number one is that Uniswap v4 hooks will use fees to buy ZEPH off of centralized exchanges. So it's my opinion that the devs are actually going to use these smart contracts to take a portion of the fees. So every time you swap between USDT and wZYS, you have to pay a small fee, and some portion of that fee goes to the liquidity providers. Some portion of that fee will actually go into a treasury or a vault contract, and it will emit an event like fees accrued amount USDT. So when a certain amount gets built up into that vault, a keeper service subscribes to that event, pulls USDT from the vault, sends it to a centralized exchange, which then buys the ZEPH automatically and sends it to the Zephyr reserve, just like what happens with block emission. So every 2 minutes, a block takes place. 35% of that block, the ZEPH from that block, 35% of it goes into the reserve automatically. That's how the devs coded this protocol, and it's going to be very similar, but in this case it's going to actually take fees from swaps and actually buy up ZEPH and push it into the reserve, and then that will be split amongst the reserve holders. So it'll actually be protecting and backing the stablecoin more and pushing the price of ZEPH up. So as it's now easy for everybody on DeFi to access wZYS, and with one click in their Uniswap wallet, they can now get this asset that has 25% APY on a stablecoin. The fees from that will grow, and that will actually push the price of ZEPH up, which will actually push the price of wZYS up, and then the whole kind of feedback loop will continue. And really that's kind of what I'm pointing out with my assumption one. Assumption number two is that swapping wZEPH to wZSD, which essentially lowers the ZEPH price, will get more expensive due to v4 hook dynamic fees. So basically what I'm saying here is that the devs understand that if the price of ZEPH goes down, you really want to protect that so that the stable dollar is always pegged to $1. And it's always pegged to $1 because it's over collateralized. If the collateral that's backing the stablecoin goes down in value close to maybe 200%, the devs can actually create a dynamic fee, which is one of the common use cases of hooks. And that fee essentially will de-incentivize people from selling their ZEPH, and rather they can actually be more incentivized to go from wZEPH, for example, to ZRS, which in some cases can be a really good option. But ZRS is a whole other kind of video in itself, so I'm not going to get into that too much. Assumption number three is that swapping wZSD to USDT, which essentially lowers the ZSD price, potentially below the peg. Keep in mind that the native coin ZSD is always $1. You can always unwrap it, bring it into your wallet, and get it for $1. But the way that these pools work, again, when there's only so much liquidity in the pool, if a lot of ZSD is sold, it will actually lower the peg on that DEX, and then arbitrage, of course, will take place to help bring that back up. But what I'm saying here is that this swap will get more expensive as well due to v4 hook dynamic fees, which will track the distance to the $1 peg and penalize further selling with larger fees, to the point that it won't ever make sense to sell below 0.9 cents, for example. Hypothetically, the devs could make it cost 90 cents in fees. So essentially you would be losing all of that money, and it wouldn't really make sense. So this incentivizes adding USD to the pool or buying ZSD, which will help balance out that peg. So we're going to talk a little bit more about arbitrage. This is actually a pretty important point. But before we do that, I just kind of want to point something out. The stablecoin reserve mechanics, this is DEXs protocol. It comes from those big brains over at Cardano and Emergo and Ergo. And if you're not familiar, you can take a look at their research where they developed out DEXs. And the way that it works essentially is that it's over collateralized, and that above 800% collateral, you can't add more collateral to the pool, and below 400% you can't mint more stable dollars because it's too low. You need to back those stable dollars by at least 400%. Also, you cannot redeem any of your reserve shares because that is what's backing the dollar, and so that's needed to keep those dollars pegged at 1. And even though the price of ZEPH has gone down as much as it has, the reserve has never dropped below about 250%. It's actually a really robust protocol. It has really protected the peg. The dollar has never depegged, even though the price has gone down so much, and it really just shows you how effective and accurate this protocol really is. Okay, so fact number 4, relatively small wrapped ZYS and USDT liquidity, likely due to potential impermanent loss, will drive price discovery on wrapped ZYS to the upside due to slippage, and it's capped to the downside. So the fact here that I'm pointing out is that when you have a small amount of liquidity, price discovery happens in both directions. But because ZYS is capped to the downside, it's really going to happen mostly to the upside. Of course, wrapped ZYS will drop below the native ZYS price from time to time, but arbitrage will take care of that. But the main point here is that slippage happens. That's a fact. And it happens because of the amount of liquidity in pool. And the liquidity is usually smaller for coins where there's a potential for impermanent loss. In this case, wrapped ZYS will go up in value, and so there is the potential for impermanent loss. If, let's say, this was wrapped ZSD to USDT, there would be no impermanent loss. There's going to be a lot of liquidity there because there's going to be incentive to get the fees from those swaps, and you will not lose any money as a result of that liquidity pair. So a lot of liquidity providers will go to that. Only a few will go to this, and it will be relatively small, which will drive upside demand. And that's because of slippage. If you don't understand how impermanent loss or liquidity pools work, you should go to YouTube and just take a look at some of the top-rated videos for that. Fact number 5, arbitrage will force ZEPH price higher in order to balance wrapped ZYS price deviations across pools, centralized exchanges, and DEXs, and there is always a capped downside because ZYS can never go down, it only goes up. Wrapped ZYS can go down due to liquidity, but arbitrage will always balance that. So this is actually the main crux of my entire hypothesis, which is that the way that wrapped versus the unwrapped version of ZYS works is such that ZYS, the native coin, will hold a certain price all the time. You can go into the wallet and get the value from it, and the wrapped version will kind of be a volatile, dynamic flux around that price point. So it'll go above it and below it over time, but it will actually pull the price up because of arbitrage. And so I really want to kind of get into some examples here because this is really where you'll start to understand what I'm talking about. All right, so let's look at some arbitrage opportunities, and this is really going to help you understand why arbitrage will push the price of ZEPH higher. And remember, when ZEPH goes up, the block reward that goes into ZYS goes up in value, and therefore the ZYS price goes higher. And as that price goes higher, then there's more incentive to buy it, which pushes ZEPH higher. So let's take a look at the arbitrage. In this first example, let's imagine that the wrapped version is below the native coin. And remember, the native coin has a value that it will never go down from. So if it's $1.60, it will never go to $1.59. It will only go up from there. It might go up very, very, very slowly, or it'll go up really fast. Nonetheless, it will never go down, and it won't even really go sideways, because every 2 minutes it will get at least some amount of money, if only a few pennies. This scenario is probably less likely than the scenario where we have wrapped ZYS being more than the native coin, but we'll talk about that in a moment. So in this case, if I want to make money off of this arbitrage, what I would do is I would take my USDT in my Uniswap or any DeFi, protocol or pool or whatever, and I would swap that $1.40 for wrapped ZYS, and then I would unwrap it. And in the act of unwrapping is where I get that extra 20 cents. Essentially just sending it back to the wallet, because there's a difference between those prices. And then when I have that native coin in the wallet, I can swap it to ZSD, and there is no slippage in this wallet. It will go exactly to 160 ZSD. That's how it works, although there is a small fee actually, but it's like 0.1%, so it's very negligible. And then I will wrap that ZSD, and I will sell that ZSD on the Uniswap or similar type of DEX, and I will get out into USDT. So in this example, I'm just trying to really paint the picture of how if somebody wanted to go from USDT to USDT, that's how they would do it. They of course could stop at ZSD and wait, but really just to paint the full picture, this is how it would get done. Now, if you wanted to go a slightly different route, you could arbitrage by directly buying ZEPH. So in this first example, it would be the swap from USDT to wrap ZYS, and then the swap again from wrap ZSD to USDT. That would create a fee that's going to eventually buy ZEPH off of an exchange because of the way that the hooks are going to work. That's my assumption. Now, similarly, you could actually just take your USDT on something like MEXC, which is a centralized exchange, and you could buy $1.40 worth of ZEPH, and then you could send that to your wallet and swap it into $1.40 worth of ZSD. Then you could wrap that ZSD, swap it to ZYS, and then you can unwrap that ZYS, and then you can swap that ZYS back to ZSD, and then from there you can just take this route where you're sending that ZSD to wrap ZSD and then out to USDT, or you could just stay at ZSD here. I didn't continue the path because there's just it's not really going to fit on the page here, but essentially from this ZSD 160 you'd essentially start at this stage and continue forward if you wanted to get out into USDT, or you could just keep your ZSD. Okay, so let's now imagine the scenario where you have wrapped ZYS, which is at a premium to the native coin. And in this case, an arbitrage individual could take $1.60 worth of USDT in their Uniswap wallet, and they could swap it for wrapped ZSD, and then they could unwrap that and they can swap it over to ZYS, and then they can take that ZYS and wrap it. And in the act of wrapping that ZYS, they will actually get that arbitrage, and then they can sell that wrap ZYS into USDT, making this 20 cents. And in the act of selling this ZYS for USDT, you actually push the price down, and it will help to balance out those price differences. All the while, you are causing fees to take place in Uniswap, which will go towards buying the ZEPH native token, pushing that price higher. Similarly, you could just go onto an exchange, and then you could buy ZEPH and send that ZEPH to your wallet. Then you can go ahead and swap that ZEPH to ZSD and swap that ZSD to ZYS, and then wrap that ZYS. And in the act of wrapping, that's really where you get that arbitrage opportunity. And then you can sell that ZYS to USDT in your Uniswap wallet, and that will actually push the price down, and that's where you will get your arbitrage, and it will balance everything out. All the while, you're pushing the price of ZEPH up in this process. And remember, if ZEPH price is going up, then ZYS is going up. And if it's going up and it cannot go down, then it will continue to go up. Because again, if it's below the price here, the native price, then arbitrage will be such that it will push ZEPH up, which will push ZYS even more. And naturally through arbitrage, this will bring this $1.40 closer to $1.60, but eventually it'll be $1.65, and then it will bring it even closer, people will realize that this is actually something they should buy, which will eventually push it even higher, and then you'll have this premium, and then arbitrage will take place, which will push ZYS even higher, and then it will continue and continue. And this is really the crux of my argument. And if anybody can note any issues with this, please let me know. I think that this is actually something that a lot of people are missing, and this is exactly why ZEPH market cap is going to $1 billion. All right, so I think this is probably not going to be a very common scenario, but it probably will happen from time to time. So it's worth having kind of like a thought about how this will actually occur. So I just wanted to lay this out really quickly. If there's a lot of ZSD being sold or bought against the USDT pair, then it may depeg on the actual pools. Remember, it will never depeg in the wallet because it's always backed over collateralized by ZEPH. You will always get exactly $1 for one ZSD that you have. That's how it works. But in the pools, it will actually have a flux around the $1 price. And of course, this is how all of these stablecoins work. You can look at USDC, for example. It did depeg on certain pools or exchanges, but it's never technically depegged because you can go to Circle, which is the company that creates USDC, and you can request that you get $1 for your one USDC. So it will never really depeg in that sense, and it's the same for the ZSD here. So on the exchange, it might be above or below the peg, but arbitrage will always take place, and that will bring the wrapped version closer to the $1 peg, and this is how it will happen. And of course, in this example here, you could just stop at ZSD, or you could continue down other paths, such as getting ZEPH or exiting through USDT through a variety of other steps. But ultimately, it will balance itself out in both of these examples. Okay, finally, my last two assumptions is that wZYS will be paired with nearly every stablecoin and will far outperform those stablecoin APYs. You can see, for example, there's something called Allbridge, and you can swap your stablecoins between each other, and eventually wZYS will be likely on this protocol, and you'll be able to swap in and out, and you'll get a lot more than 15% APY. 25% on an APY is the leader of every coin, and it's soon going to be available on DeFi platforms. So it's going to be outperforming all of the other stablecoins, and you can swap in and out of all types of stablecoins. It's going to actually end up pulling a lot of liquidity in to ZYS, which will cause ZEPH to go higher through fees, slippage, and arbitrage, which will cause ZYS to go higher, and really this whole thing is going to get going very soon. Okay, so my last assumption is that at least $75 million will move into wZYS once it is paired with other stablecoins on Uniswap and easy to buy via MetaMask. That would essentially push the market cap of ZEPH to $1 billion. The reason that this will go to $1 billion based off of these numbers is that $75 million into ZYS means that $75 million worth of ZSD has to be minted, and it has to be over collateralized by at least 400%, which pushes the collateral to 4 times 75, which is $300 million, and $300 million is what would be required to be in the reserve, and right now the reserve is a little bit less than 30% of all the circulating supply. So if that remains the same, then the market cap of ZEPH would have to be $1 billion, just based on the number of circulating supply of ZEPH at the moment and how much is in the reserve. So if you have questions about this, I can lay it out for you. All the numbers add up and it makes sense, but the $1 billion market cap is based on my assumption that $75 million is going to move into wZYS. And, honestly, probably maybe $750 million could move into this, or $1 billion or more, right? I don't think necessarily that will happen right away. I think probably there will be people wondering what this is, and maybe some small people will move in, and then it will grow. That's why I'm being conservative with 75 million. Maybe it's only 10 million. And even if it was 10 million, that's, let's say it's actually 7.5 million instead. That would push the market cap of ZEPH to 100 million. Right now, the market cap is like 5 million, so that's still like 20x or something like that. I really think that ZEPH is really super undervalued. Okay, so finally, I do want to point out there are, of course, risks, as there are with anything in crypto. Some risks that I've kind of pointed out here, V4 hook contract risk or exploit risk. So the devs are going to code up some new smart contracts with Uniswap, and of course, that could be exploited, and it could be an area where there's risk, and you should, of course, keep that in mind. That code should be audited, and it's going to likely be open source. All of ZEPH is open source, so you can go look at the code base if you want. And I think that this is something I'm not really that concerned with because the dev code has never actually been exploited. It was only code that they inherited that was already audited in the first place. So I don't really have any concerns about this, but of course it is a potential risk. The price of ZEPH, if it does continue to go down, then this really won't work. And if it goes down, that just means nobody really trusts that this will work. And trust is really important. And I think if nobody does trust that this will work, then I think ZEPH will continue to go down. Just because emissions, right? It's a proof of work blockchain. The miners are going to sell. They're going to have that sell pressure. So if there's not enough trust to buy the amount of emissions that's coming out, then it will kind of trend down. And I think there's also just a lot of fear, so people will kind of push narratives about how maybe the exploit is ongoing or something that's not been verified. And so holders may be selling also into some of that fear. But in my opinion, as long as wZYS has any amount of buy pressure, then ZEPH won't continue to go down. And I'm actually going to start buying wZYS just to push it higher. That's going to happen. I think other people are going to do that. We're going to get this whole flywheel effect to really get going. And then the last potential risk is if there's a ton of ZYS minted, then that dilutes the shares and it will slow the price of ZYS. But the fact of the matter is, this actually is not a potential risk because it's only a risk if you don't understand how it works, and it's really not a risk then. It just means you really don't know how it works because you can't mint a ton of ZYS out of thin air. You need ZSD to be a ZYS shareholder. And the only way you can get ZSD is by natively going into the protocol and actually swapping ZEPH for ZSD. So you have to buy ZEPH somewhere. And buying ZEPH will essentially have the effect of pushing the ZYS APY higher, and with that APY being higher, it will actually counteract the number of people minting ZYS. So one final thought before I end the video is that ZYS has a limited supply, and the wZYS is also limited. It's based on the native coin, so when you go to unwrap your ZYS, you're going to end up burning that wrapped version, and then the contract will release the original native coin. And there's only so many native coins, and then you get that coin locked up when you go and wrap it and bring it to Ethereum over the bridge. And because there's a limited supply in the pool, that will cause there to be somewhat of a supply shock, which can drive the price higher, which eventually will actually cause people to want to go into the native wallet and mint their own ZYS, which will actually end up increasing the total supply of ZYS. And of course, there are benefits to being in the native wallet. If you guys like this video, leave me a thumbs up, leave your comments below,